Tariffs didn't break global trade, they revealed who controls it. Introduction: The illusion of destruction. Every few decades, global trade is declared dead. A war, a pandemic, a financial crisis, a tariff regime. In 2025, tariffs returned to center stage. The United States, under Donald Trump, re-weaponized trade barriers at scale. Commentators predicted collapse, broken supply chains, crippled exporters, suffocated banks, and a reversal of globalization itself. That did not happen. Instead, something quieter, colder, and far more revealing occurred. Trade didn't collapse, they refigured. In that refiguration, the true hierarchy of power inside global trade was exposed. And today, we are going to find out why exactly tariffs failed to break the systems and why banks endured and in many cases benefited, and why the real story of global trade has nothing to do with goods, border, or even ideologies. It has everything to do with control and movement. Point number one: trade is not fragile, it is adaptive. The first misconception is that global trade is a delicate structure that collapses under pressure. It does not. Trade is one of the most adaptive systems ever built because it evolved under constant constraints, wars, embargoes, piracy, blockades, currency crises, colonial monopolies, and state violence. Tariffs are not an existential shock, they are a familiar one. When tariffs rise, three things happen immediately. Time is pulled forward, firms accelerate imports before penalties apply, inventory surges, warehouse fill, ports congest, routines mutate, supply chains detour around political friction, China to ASEAN, US to Mexico, Europe to Turkey or North Africa. Risk becomes explicit. Currency volatility increases, counterparty risks become visible, credit terms tighten. None of this stops trade, it changes geometry. And geometry is where power hides. Why tariff create activity, not silence? Tariffs do not create stillness, they create urgency. Urgency generates demand for letters of credit, guarantees, forex hedging, short-term working capital, inventory financing, supplier onboarding platforms. In other words, tariffs inflate the transactional surface area of trade. A container shipped under stable conditions requires minimal intermediation. A container shipped under uncertainty requires financing buffers, risk transfers, payment assurance, currency protections, compliance layers. Trade finance doesn't exist to support trade, and when trade is easy, it exists to make trade possible when trade is difficult. That is why banks do not panic in 2025, they prepare. The front-loading mirage, borrowed strength. The apparent resilience of global trade in the early 2025 must be understood correctly. It was not organic growth, it was borrowed time. Companies rushed imports to avoid tariffs. Demand was not destroyed, it was displaced forward. They produced stronger quarter one and quarter two numbers, followed by visible softening in later quarters. This pattern is dangerous because it creates a false sense of durability. Front loading has three consequences: warehouse saturate, cash conversion cycle stretch, credit quality weakens downstream. Trade finance always looks strongest before credit risk emerges. The real damage of tariffs isn't immediate, it arrives later, quietly in loan books, impairment ratios, and refinancing stress. Winners are not bigger, they are positioned. The tariff episode exposed a brutal truth: size doesn't determine survival, position does. Structural winners, platform banks, those embedded in transaction infrastructure thrive. They control payment trails, supply onboarding, FX quality, documentation flows. These banks do not depend on any single trading route, they monetize movement itself. Citi exemplifies this model. It doesn't care whether trade flows from China or to the US. Vietnam to Europe, Mexico to Canada, it sits inside the pipe. Similarly, the HSBC and the Standard Chartered survive because of corridor flexibility. Their exposure isn't ideological, it is rational. as well as national. Focusing explicitly on logistics, let's talk about the structural vulnerabilities. Banks tied to export-heavy national models, energy-dependent industrial base, pure lending rather than heavy fee structures, faces external pressure. Germany experience is intrusive. Trade volumes remain, but credit risk grows. Energy cost, bureaucracy, supply chain exposure quietly undermine balance sheets. This is how systems fail, not explosively but selectively. Trade finance is not about trade. This is the central insight. Trade finance is not about ships, factories, or goods. It is about movement under constraint. Who decides when goods move? Where they reroute? Where risks are absorbed? Who gets paid first? Who bears currency volatility? These actors are not governments, they are exporters, they are manufacturers, they are financial intermediaries embedded in the flow architecture. Trade finance is power exercised indirectly, invisibly, continuously, and this is why it survives political change. It survives when profits shake volatility. It survives when it is rarely discussed honestly. Volatility is not a threat, it's a revenue model. Popular narratives treat volatility as a failure state. For trade finances, volatility is a business model. Volatility increases forex spreads, hedging demand, guarantee insurance, short-term credit utilization, advisory leverage, stability compress margins, chaos expands them. This is not cynicism, this is structural reality. Banks that fear volatility die. Banks that price volatility dominate. Credit risk, the silent face. The true danger of tariffs is not trade disruption, it is credit distortion. As inventories accumulate and demand normalizes, weak exporters struggle, forex mismatches surface, rolling short-term credit becomes harder, defaults rise quietly. This phase doesn't make headlines, it appears in loan loss provisions, impaired trade assets, declining LC issuance, reduced contingencies. By the time it is visible, selection has already occurred. Conclusion: the system endures because it is designed to. The most important lesson of the tariff episode is not the economic results. It is philosophical. Global trade is not governed by ideology, it is governed by architecture. As long as goods must move, capital must clear, risk must be priced, time must be brigade. Trade finances will endure quietly, relentlessly, indifferent to politics. The system doesn't need optimism. It need not need stability. It need not need consensus. It only needs movement under constraint. As long as that exists, the system will not break. It will adapt.